All right, well, I see a couple of people joining. Let's get started. Thanks everyone for joining us. My name is Lucas Otomuro. I'm senior analyst at Into the Block. I lead our research efforts into new and growing areas. And of course, today I'll be talking about the relationship between crypto and capital markets. So here's the agenda for today. I'll start talking about crypto's role within traditional finance and how it's grown throughout the years. Then I'll dive into more of an investment lens comparing crypto versus capital markets. And then I'll get slightly more theoretical, talking about the coexistence of the emerging DeFi space, decentralized finance for those not so familiar, and traditional finance and how those can coexist. But before that, I just want to give a quick update about something we're really excited to share with you guys. It's the new section, which of course we've been teasing, is the main topic for today's webinar as well. It's called Capital Markets Insights. And our reasoning behind this is that we've seen a confluence in interest between traditional markets trading and crypto throughout the last year or so. But there's no centralized platform where you can compare one performance versus the other. So for instance, compare your favorite stocks, not just in price, but also in terms of volatility, correlation, some of the key metrics that any investor has to know to consider crypto versus capital markets. And so that's what we're launching. I'll be providing throughout this webinar overview of the main metrics that we'll be releasing, and also how you can use them to improve your understanding of crypto and trading in general, really, and investing. And we're also excited about this short feature that it's long overdue. Users will now finally be able to download data from Into the Block. That way they can make their own models and make it a lot more iterative for them to create their own analyses. And finally, with the release of our Capital Markets Insights, we're also providing a discount code for a limited time of 30%, which our team will be providing through the chat shortly. Take advantage of it. As well, I forgot to mention, but a few key pointers. In case you have any questions in the middle of the webinar, feel free to write those in chat, or myself and the team will look and be answering them if it's referring to a particular slide. And yes, we will also have a recording for the webinar. So if you can't stay the whole time or you'd like to share it after it's done, I will be posting a recording on our YouTube page tomorrow. So yeah, that's it. And I want to get started now with some context. Recently, crypto surpassed the $1 trillion market cap in aggregate between all cryptocurrencies. And this sounds like a massive milestone, but in reality, it's still relatively small compared to traditional finance. And so just how small is crypto? Well, there's this great visualization from the source is Visual Capitalist. I updated it, it was from a year ago, so I updated it to increase the size of cryptocurrency. But you can see here in the visualization, each square is roughly $100 billion. And if you compare crypto's $1 trillion to gold, 14 trillion, and global debt of over 250 trillion, you can see that it's crypto is still relatively negligible in the lens of broader wealth. And I didn't even include derivatives in this slide because it would take like 2 more slides at an estimate of 500 trillion to over a quadrillion in derivatives. But you get the picture, you get the gist of it. Crypto is still relatively small and nascent market compared to traditional finance. But it's managed to grow, of course, significantly since its inception. I'm zooming out. Of course, the last year has been stellar performance for crypto, but zooming out even 3 years ago, February 2018, just after markets crashed from like 20,000 to 6,000 for Bitcoin within a couple of weeks. 3 years later, we see Bitcoin already surpassing its all-time high, of course, and more recently Ethereum. And in terms of performance, we see that even the Nasdaq, which has had an impressive 90% or so by traditional standards, which is really impressive, that we see crypto in general outperform it, well, at least Bitcoin in a 3-year perspective. And in the 1-year perspective, since it's gone full bull market, of course, both Ethereum and Bitcoin have been an outstanding investment in terms of performance. I'll get into more details later, and the reasons essentially behind this. There's 3 main factors that we've identified as the leading forces behind crypto's growth in the past few years. One is, and this was a common theme, recurring theme throughout 2020, is Bitcoin as a store of value or digital gold. The other, which is related to this, is institutional adoption, mostly of Bitcoin, or also to some extent in Ethereum. And finally, the world, I believe, is waking up to the proposition of decentralization. And there's a lot of metrics to back this. I'll dive into more details later. So I'll start first with Bitcoin as a store of value. Essentially, following the COVID-19 pandemic, the world has reached amounts of debt, massive amounts of debt, and there's worries, of course, that some people believe that it might be reaching unsustainable levels, and as well, given the massive, unprecedented amount of money supply entering the economy, there's the risk of potential inflation, and this is being reflected in expectations of inflation. And finally, there's demand for Bitcoin and gold too, as an asset of scarce supply. So we see this exemplified in on-chain data as well. So the store of value proposition for Bitcoin, essentially, if you go back to what a store of value means, it's an asset that is held with the primarily purpose of it sustaining and retaining its value and accruing value long term. And we see through the UTXO age, we see the amount, essentially what this shows is the average time that a Bitcoin is held, and we show this in percentage wise. And we see long-term players have been growing constantly, as you can see with the waves in blue and green. And we see this recurring trend of the cycles in Bitcoin, where first long-term interest grows, and then of course, as the bull market begins, we see short-term interest in red and orange spike back up. And it's exactly what we're seeing again back in late 2020 and 2021 as short-term interest takes over. But the store value narrative is essentially exemplified by the long-term holding of these players. And as a store of value, we can compare this to gold, which is the most notorious example of a store of value. We see this graphic comparing Bitcoin versus gold in terms of market share. Well, not market share, the percentage that it represents out of gold. And it's still, despite its increase, it's still roughly 4.5%, which it also provides the opportunity of asymmetric upside, being a smaller market cap asset. Of course, this is something that has attracted a lot of the institutional heavyweights, is that Bitcoin being smaller market cap, potential hedge to inflation and store of value, it has higher potential of appreciation, especially in the digital era that we live in. And of course, this is linked to the institutional adoption that we're seeing in crypto. So we see, as I was mentioning, the digital gold narrative spreading throughout Wall Street. We see institutions like Fidelity, BlackRock, Square, PayPal, and MicroStrategy. Some of these holding it, in the case of Square and PayPal, holding it in their balance sheets. And in other cases like BlackRock, they filed for the potential of them adding it. And they also have a lot of their users, as well as in Fidelity and family offices using Bitcoin, holding Bitcoin. and PayPal, of course, giving that stamp of approval for institutions supporting that, as well as renowned Wall Street investors like Paul Tudor Jones and Stanley Druckenmiller, and more recently, not from Wall Street, but very well known, Elon Musk openly supporting Bitcoin. And we've seen this trend in institutional adoption with over 43 billion, probably 44 billion by today, given the price increase, or roughly 5.8% of all Bitcoin held by companies and trusts. This is using data from Bitcoin treasuries. And similarly, we see this pattern emerge in on-chain data as well. So one of the metrics we keep a close eye on at Into the Block is the large transactions volume, which essentially aggregates the total amount transacted in transactions of over $100,000. And we've seen massive growth in the large transactions volume in the past year. And of course, given that it's a pretty large sum of money, this acts as a proxy, I should say, for institutional and whales activity. And we see the same pattern in average transaction size, which has now surpassed over $200,000, which of course is a large sum, and it exemplifies the level of institutional adoption that Bitcoin has reached. Finally, the third theme we see driving crypto forward this year and beyond is the growing proposition of decentralization. So just in this past month or so, since January, we've seen a massive spike towards censorship, as seen first with President Trump and the platform Parler essentially getting canceled. And whether you agree with it or not, it shows the power of platforms that they have, essentially choosing what they want to believe and censoring the information that's out there. Similarly, with Robinhood, they recently disabled buying for GameStop amidst the buying spree from Reddit Wall Street Bets, and they censored the Wall Street Bets Discord without much notice. But essentially, this shows what the pressure from traditional institutions can do when there's a central player controlling both information and finance. And due to this, there's an increasing amount of awareness towards decentralized alternatives. And we are seeing this, well, we've been seeing this even earlier with the adoption of decentralized finance protocols. So what we're seeing here is a metric that many of you might be familiar with as a total value stored or locked in decentralized finance protocols, which has grown from $0 3 years ago to over $30 billion now, essentially adding liquidity to these protocols to offer financial services in a decentralized way. And now I'll move into how we can assess, using Into the Block data, how you can assess investing in crypto versus comparing investing in capital markets. So first, I'll take a step back and just ask the question, what makes crypto different from traditional markets? And there's, in my opinion, 3 main factors. There's certainly more, but I would identify these as the main ones. First is that it's global and permissionless. So it's in the internet, anyone can access it, and in some cases, for centralized exchanges, you might have to use KYC, but it's also permissionless if you use more decentralized protocols, meaning that you can access it anywhere in the world, but at the same time, it's also more manipulatable. So given that you don't have to show your identity, there's also higher risks as people try to manipulate these markets. And we see this, of course, reflected with the higher volatility that crypto is known for. Being a very nascent market, just over 10 years, crypto is very volatile, and it's likely to remain so for the next few years. And finally, and a key difference also is that traditional markets close, of course, typically 9 to 5, whereas crypto doesn't sleep. You can debate if this is a feature or a bug, but it's a key difference in the activity you see trading, especially in the weekends. I'm gonna stop quickly. I see a question. I don't know why the Q&A is not loading. Okay. Okay, the question is in French. So I guess I don't speak French. I'll skip that and continue going. Sorry about that. I think maybe in the YouTube recording, we can add French translations if you're interested. Anyways, I'll move on. I'll continue. So one of the things I was mentioning is that crypto is known for its volatility, which of course is significantly higher than traditional markets. And so at Interblock, we provided metrics for volatility. In this case, on the left, you see 30-day volatility for the last year for Bitcoin, Ethereum, and the main global indices. And we see them, of course, being a level higher, even though in March, pretty much all financial assets saw a remarkable amount of volatility. Here we see that the Bitcoin and Ethereum sustained higher levels, essentially at 100%. And it means it's been increasing 100% of its value within the past 30 days. Well, changing can be in both directions. And we also show this as the average intraday move, which is slightly more understandable. Essentially, what this means is that over the past year, the average day, on the average day, Ethereum has increased by 0.64%, while of course global indices have had much smaller changes. And now versus tech stocks, in context to the very highly traded tech stocks, we see Bitcoin and Ethereum are actually not so volatile, especially in the times of high speculation that we're seeing ourselves in. So Tesla, in this case, has been more volatile throughout the past year, even though it's essentially because it has higher intraday move because it trades less days than Ethereum. But in the past 30 days, Tesla has been less volatile than Bitcoin and Ethereum, but it still showcases that the amount of excitement and trading that goes into crypto, it's not just exclusive to crypto, and it's also being seen in some of the most traded stocks. We have another question from Javier Acuna, asking why it trades on weekends. So crypto, being digitally native, doesn't sleep. So the internet doesn't sleep, and it makes sense for a digitally only product to be accessed at any time of any day of the year. I guess that's a short answer. And now you may be wondering, especially if you're relatively new to crypto, is investing in crypto worth the additional risk and volatility? You know that the Bitcoin's gone down 80%. Some of the other tokens have gone down more than 90%. And so is Bitcoin and crypto in general worth the additional volatility? In short, yes, we see with ratios that take into consideration the volatility and the risk-adjusted returns, most commonly shown as the Sharpe ratio and the Sortino ratio, we see Bitcoin and Ethereum have superior returns in a risk-adjusted basis over the past year. So what does this mean? I'm going to bring it one step back before and explain that the Sharpe ratio is essentially, for those that don't know, it's the return of the portfolio or asset over its standard deviation of the returns. It's usually done as the excess returns using three-month bonds or something as a risk-free rate. In this case, risk-free rates have gone near zero, so it's essentially just the return over the volatility of an asset. So the volatility is a proxy for the risk you incur investing in crypto. And if it has a higher return relative to its volatility, essentially it's a better risk-adjusted return. And that's what we're seeing with Bitcoin and Ethereum throughout the past year. With the higher the number in these cases, we see these investments being superior to traditional indices. And in the case of the Sortino ratio, it's adjusted so that it only accounts for the downside volatility. And so even though Bitcoin and Ethereum crashed more than 50% back in March 2020, they still have managed to make their high returns worth the additional risk seen from the volatile environment in crypto. And comparing to top performing stocks, we see a similar trend. So only Tesla, which has been one of the best performing stocks of the past year and a half, matches the level that Ethereum has reached in terms of being a better risk-adjusted return. And you have to take into consideration that in Into the Block, we're ranking these by the top 3-month performance. So I only am showing 3 stocks right now, but in the platform, you'll be able to see these and many more stocks. And essentially, compared to the top 3 stocks, crypto still has a very high risk-adjusted return. And there's another factor, of course, that you'd have to consider when investing in crypto or in any asset class for that matter. And that's how crypto is affected by broader markets and how these correlate. And what we've seen throughout the past year or so has been generally in periods of high volatility, like the one seen in March, and some of the corrections seen, we've seen volatility increase and the correlation, tie together. So of course, with correlation coefficient, the greater that value is to 1, the more positively correlated these are, meaning that they move in tandem one with the other. And throughout the year, we've seen cycles between correlations between the NASDAQ and S&P 500 and Bitcoin, where it's heavily correlated and then drops. Recently, since the bull market really took off since November, we've seen it first decrease and now decrease again, and a very interesting inverse correlation versus the dollar. So since Bitcoin's typically denominated in dollars, of course, as the value of dollars drop, Bitcoin's relative value increases. And also due to the increased amount of supply, there's also this solidifies Bitcoin's proposition as a potential inflation hedge, which in turn further exacerbates this inverse correlation versus the dollar. And finally, before we move into the next subject, I just wanted to give a last sneak peek of how the interface is going to be looking. We're excited. We're going to be launching this in the next week or so, actually maybe even tomorrow from what I'm hearing. So keep an eye out for it, and you'll be able to see something, compare things like Bitcoin versus MicroStrategy, which of course has become like the unofficial Bitcoin ETF, given to the high amounts of Bitcoin holdings that they have. And you can compare, for instance, how they've somehow managed to outperform Bitcoin. And so these are some of the features. And of course, you'll be able to see a lot more ETFs, commodities, and indices that you can play with. I'm getting another question from Rahim. You're asking, can trend lines and other chart reading tools be used to determine the dips in cryptocurrency? So I guess you're referring to technical analysis. In a way, technical analysis can be sort of a self-fulfilling prophecy or theory. I'm not a huge fan of it, but in reality is so many people use it that if too many people are looking at certain levels of support, for instance, and if it breaks, everyone's going to be selling because everyone's looking at the same charts and the same lines, or at least a large amount of people. So in a way, yes, I guess it can be used to anticipate dips, but it's definitely not something that that applies all the time. So take it with a grain of salt. And in InfoBlock, we provide a lot of information for you to identify more of the fundamental side of things and how to assess investments, whereas technical analysis is more of timing, if anything. But anyways, I digress. I'll move into quickly to our last topic for the webinar, which is essentially the emergence of decentralized finance and how it's coexisting with the world of traditional finance. So first, as I've been doing with the other topics, I'll take a step back. What are the key differences between DeFi or decentralized systems in general and centralized systems? One of the key differences, of course, is that decentralized systems are, in general, censorship resistant if they're well decentralized. So there's no central point of failure. And what that means is that these networks are more robust. They can't be tampered with. They're immutable. So essentially, you can't change them in the past. But this also brings the downsides, potential downsides, I guess, of, for instance, from what I've been hearing people argue, is that there's decentralized communities can often lead to outcomes that are exacerbated by mob mentality. So, for instance, what we saw in January with the storm of the Capitol is that a group of decentralized people essentially got into the mentality, mob mentality, and ended up doing things that they might have not done by themselves. But since too many people were doing it, they thought it was okay. And centralized systems are much better at essentially fixing those issues, which is why I'm calling it centralized as being mob resistant. While decentralized systems, it's harder for you to have rules essentially, even though these might be applied through smart contracts. So that's one trade-off between decentralization and centralization. And there's the efficiency versus robustness trade-off, which I should describe as centralized systems are more efficient. They can handle faster throughputs because they don't have to go through as many nodes. They're quicker, faster to execute, while decentralized systems, there's usually a lag between governance and the next steps. So it can often be slower and at lower capacities. And I'm going to talk about why DeFi has to stay decentralized to fix some of the outcomes and some of the issues from traditional finance. So I believe, I think many of the leaders in the industry are going through this path, that DeFi will likely grow in parallel, at least for the coming years. And the main reason is this decentralization. So if you want to, decentralization and regulation, I should say, which are linked to each other. So if you're, for instance, bringing traditional assets, securities on chain, so a lot of people were talking with the Robinhood issue that trading should just be done in a decentralized way. And while I'm in favor for permissionless trading, this brings the issue of essentially being an unregulated securities platform. And if there's a small team in control and there's concentrated teams leading some of the DeFi protocols, this might be a potential risk, as there's a central party or that has maybe not all control of the network, but a significant amount of control. And this brings risks, and essentially DeFi protocols don't want to end up like Ripple. So that's a potential risk if they do a lot of the things that regulators are not comfortable with, especially if it's just amongst a concentrated amount of people. So that's why the DeFi has to stay decentralized, as the name implies, even though there's lack of clarity from regulators on what's decentralized enough, which essentially Ethereum classified as decentralized enough, but Ripple didn't. So there's a lot of lack of clarity there. As well, there's barriers to adoption for DeFi. I'm going slightly over the moment, so I'll go quickly through them. Essentially, there's a learning curve to use Ethereum, and most of the applications built on top of Ethereum and other layer 1 blockchains. There's scalability issues, which I was talking about in the efficiency versus robustness trade-off. These are getting worked on significantly, and there's solutions being implemented by the day, but it's still not ready for mass adoption for the time being. And one of the reasons is also because it's not scalable. It's also higher costs. So Ethereum fees right now to make a small trade or transaction, it can be as much as 10% or more, depending on the amount you're transacting. So it's still in that sense not ready for mass adoption. And what I believe, and what is likely to be the path for these forward, is that eventually there will be a convergence between DeFi and traditional finance. Once the regulators essentially provide more clarity on what is essentially decentralized enough and what can be powered by decentralized platforms, and where there has to be an intermediary providing safety for users. Of course, there will always be, in my opinion, the censorship-resistant DeFi platforms where you essentially don't need to abide by regulations in a way. But what that also brings is a risk of you being your own bank, and something that goes against human, not nature, but what we've lived in the past few years, not in our history really, is having a central party who to criticize or who to go to, at least when you have an issue, which is a harder thing to do in a completely decentralized environment, of course. And we see also the emergence of CDeFi, or centralized DeFi. And this has been already happening with key players like Binance and Gemini supporting products and use cases of DeFi. So for instance, staking, you can obtain staking rewards on Sushi, the SushiSwap token on Binance, and earn a fraction of what you would be earning if you're earning just directly from the DeFi protocol. But of course, some people are just comfortable with the user experience of using a centralized party. So I believe that this trend of CDeFi will continue to grow, and will actually probably expand to fintechs in the next coming years, as there's an increasing amount of competition with some fintech platforms going public. And as the yields decrease, I think there will be a likely temptation and the alternative of using yields through DeFi of over 8 to 10%, whereas traditional world is less than 1%. So maybe these yields may accelerate the path towards the DeFi and traditional finance convergence, but there's certainly a lot for regulators to clear out before this fulfills. In summary, crypto has grown remarkably, but it's still relatively small to the trillions of hundreds of trillions of market size. This narrative, crypto has been propelled by the narratives of Bitcoin as a store of value, institutional adoption, and the growing proposition of decentralization. Despite its volatility, as I show when comparing investments, crypto has been an outstanding risk-adjusted investment, both in the past year and since its inception. And there's issues that can be solved by DeFi with traditional finance. Some traditional finance issues that can be solved by DeFi, but they're likely, as I was saying, to take different paths as DeFi is likely to evolve on the decentralized path and traditional finance down its current path. Thanks everyone for coming. This is the link for our next webinar. Our CEO Jesus will be hosting it. And now Again, thanks everyone. I'll stay a few minutes in case you guys have any questions or feedback. As I mentioned, we're going to release the capital markets insights section soon. So I hope you guys enjoyed it. And if you have any questions about it or any of the topics that I covered or even broader topics, I'll stay on for a couple of minutes and hear you guys out. So I'm opening the chat. Seems like we have a lot of questions in the chat. I'll start from the top quickly. So is the video going to be available offline? Well, it's going to be available online, but it'll be in our YouTube network, YouTube channel. I mean, you can find it later, tomorrow usually. And Ahmed is asking, when will the data be available for download? And could you clarify what data will be available to download? So our plans is to release the download feature along with the capital markets insights. And it will not just be for capital markets, it will also be for our traditional indicators, so on-chain, market data, social data. So a lot of metrics, all of our metrics really are going to be downloadable. But it's only for free trial users or subscribers, of course. Christian says, hello, thank you for the seminar. Does a subscription allow you to download data for academic research? Yes, Christian. In fact, if you're doing academic research, feel free to reach out to me at my email or Twitter. I help with some of the people that are doing master's thesis and things along those lines with crypto. So feel free to reach out. We can help you out, but also at the same time, you'll be able to download this data with a subscription, as I was mentioning. Olga asks, there's a quite bit of noise from someone typing. I guess it's too late for that. On what period, Adrian's asking, was the Sharpe ratio graph made? So the one I was showing was for 1 year, but the period will be able to be adjusted in the platform. You'll be able to see 30 days, 90 days, 1 year. So that way you can find in a particular time that's interesting for you, you can find the Sharpe, calculate the Sharpe ratio. Sorry about the static. Apparently there were some issues. I should have opened the chat earlier. And Christie's asking when ITB will provide access to APA data for normal users. So in this case, for regular users, we're launching the option to download data first. To be streamed through API is a significant effort from our engineering team. And while we do have it in our backlog, it will take a few more months. So I guess at least in the meantime, you'll be able to download data and manipulate it as you wish. Raheem, the recording is going to be available through our YouTube channel, and we'll also share in our social media. More messages, a lot of questions. So Andrew asked, with a 24/7 crypto market, is there a particular period in the 24-hour cycle where a higher percentage of volume is traded or volatility higher? So I found a study from a year ago, I think. Usually American trading sessions, so 9 to 5 Eastern time, has higher volumes. And I believe the last hour, so 3 to 4 is usually, in a study I read, the period with highest amount of volume. I don't remember if it's the highest amount of volatility, but volume at least, and those tend to go hand in hand. Rick says, brilliant product. Thanks for the updates. Rick, thanks to you. We couldn't be doing this without you guys. Thanks everyone for coming. A lot of things here. Clear and concise, appreciate it. Holmes is asking, why do you think technical trading as a self-fulfilling prophecy? So I think that's putting it in a good way, which that's what I said. But it's what I mean is essentially if everyone's looking at the same resistance line and it breaks out, essentially people are going to buy. So it essentially exacerbates that behavior of what's anticipated to occur, unless of course too many people buy in anticipation of a breakout, and then the opposite can happen. But usually, especially in larger time frames, it typically happens. In shorter time frames, it can be a fool's errand, but that's at least what I'm seeing with crypto. And I expect this to be probably less relevant as the market matures, but we'll see. Bell is asking, how important do you think NFTs will be in the DeFi space? So I've been a fan of NFTs for a couple of years now. I think NFTs are still in their early stages because they're not liquid enough, especially. It's because they're unique and there's high fees. So for the time being, it's still likely to play a small role, but it will increase as DeFi expands, and you'll probably be able to get collateral against an NFT if that NFT is like a very liquid NFT. But as I said, there's issues with that in a small market. Marcel asks, I'm very interested in signing up for Into the Block, but I'm not sure how to use all these data. Do you guys plan to provide trainings on how to read all the data? Yes, so actually, Marcel, we have, as soon as you sign up, you'll get some emails for the next week or so for the free trial, guiding you through how to use our indicators. And there's also the resources section. So in the resources section, you can look at literally every single indicator and what it is and how to use it. So it's very hands-on. And at the end of the day, we want to make you a better researcher, investor, whatever you need. Raheem asks, can you please give a brief description of DeFi once more? I'm gonna give a plug to a research paper that I did. So if you go into our DeFi section, you can read a more elaborate research paper here. But essentially it's decentralized finance, it's permissionless, it's open, so it's transparent, and it's global. I can talk about this for ages and it's already over the time, so I won't. But you can read that if you guys are interested in more. And okay, last question. Bell, oh, okay, I already answered that. Okay, well, we're already way over the time. Sorry if I didn't get to answer all the questions. Thanks a ton to everyone for making it. Really appreciate it, and I hope you guys are excited as we are for the final release, which will be out in the next couple of days. So have a great day, everyone, and stay safe. Bye now.